Let's cut to the chase. Government shutdowns aren't just political theater, they hit your wallet. When the government grinds to a halt, it's not just a headline, it's a financial earthquake that can shake your personal finances to the core. When Congress and the president can't agree on a budget, non-essential government services stop, and the ripple effects reach your investments. This means delays in everything from tax refunds to business loans, creating a cascade of financial disruptions. This isn't just a DC problem. The impact spreads far beyond the Beltway, affecting every corner of the country. It's a threat to your 401k, your brokerage account, and your job security. Your retirement savings can take a hit, and your investment portfolio can see significant losses. Why? Because the stock market hates uncertainty, and a shutdown creates a cloud of doubt over the entire economy. Federal workers go unpaid, local businesses lose customers, and consumer confidence takes a nosedive. And key economic data stops flowing. This lack of information makes it harder for investors to make informed decisions, adding to the market volatility. That domino effect can spook investors, trigger sell-offs, and drive down stock prices. The fear of the unknown can lead to panic selling, further exacerbating the market decline. Imagine you're a small business owner supplying the government. Overnight, your income vanishes. Contracts are put on hold, and payments are delayed, putting your business at risk. Multiply that across the country, and you see why Wall Street gets nervous. The broader economic impact can lead to a slowdown in growth and increased unemployment. A prolonged shutdown can shrink the economy, cut corporate profits, and lead to layoffs. Companies may scale back on investments and hiring, further slowing economic momentum, and drag down the market. The longer the shutdown lasts, the more severe the economic consequences become. So, when you hear about a possible shutdown, don't tune it out. It's a direct threat to your financial stability. Stay informed and understand the potential impacts on your investments and savings. The longer it lasts, the more damage it does, and the more investors panic. This can lead to a vicious cycle of declining confidence and economic instability. It's a test of confidence in the government's ability to function. When that confidence is shaken, it affects everything from consumer spending to business investments. When that confidence erodes, so does the willingness to invest and take risks, the lifeblood of the market. Investors become more risk-averse, leading to lower market liquidity and higher volatility. Understanding this link is the first step to protecting your money. Educate yourself about the potential impacts and consider diversifying your investments to mitigate risks. Don't ignore the headlines. Your financial future depends on it. Stay proactive and consult with financial advisors to navigate these turbulent times. Stay alert. Your money is on the line. In times of uncertainty, being informed and prepared can make all the difference. After weeks of market anxiety, hope finally broke through. On November 9th, news of a real deal to end the shutdown sent shockwaves through Wall Street. The Senate advanced a funding bill with bipartisan support, a breakthrough after weeks of gridlock. The market's reaction? Instant and powerful. Even before Monday's opening bell, stock futures soared, signaling a massive wave of relief. Investors saw the end in sight and rushed to buy back in. The proposed bill would fund the government until January, giving everyone a window of clarity. That certainty was a green light for sidelined investors. The market, stuck in fear for 40 days, swung sharply back toward optimism. Short sellers scrambled to cover, fueling the rally even more. This surge showed just how desperate Wall Street was for stability. When Washington moves, the market roars. Let's talk numbers, because in the world of finance, numbers are more than just digits on a screen. They're the pulse of the market, the heartbeat of your investments, and the signals that guide every major decision. Understanding these numbers is key to making sense of what's happening on Wall Street and beyond. Numbers drive your financial life, shaping everything from your daily spending to your long-term wealth. They tell the story of risk, reward, and opportunity. And today, they're telling a story of renewed optimism. By early Monday, Dow futures were up 230 points, a solid 0.5% gain. That's a clear sign that investors are feeling more confident, and it sets the tone for the rest of the market. The S&P 500 futures jumped 66 points, up 1%, a big move for such a broad index. When the S&P 500 moves like this, it means optimism is spreading across many sectors, not just a select few. But the real star of the morning? The Nasdaq 100, up a staggering 380 points, or 1.5%. That's a huge leap, especially for an index so heavily weighted toward technology and innovation. That's classic risk-on behavior. Investors piling back into tech and growth stocks, betting on future gains, and showing a willingness to embrace more risk for higher rewards. The optimism wasn't just for a few companies, it was market-wide. From blue chips to tech startups, the rally touched nearly every corner of the market. These gains told a story: relief, renewed risk appetite, and hope that the government shutdown would finally end. Investors were clearly reacting to positive headlines and a sense that the worst might be behind us. The biggest jump in the Nasdaq showed investors were especially bullish on tech, signaling faith in innovation and the companies driving the digital economy forward. When the threat of shutdown fades, the market prices in a brighter future, fast. It's a reminder of how quickly sentiment can shift when uncertainty is removed. This is how quickly Wall Street sentiment can turn. In just hours, fear can give way to hope, and caution can flip to enthusiasm. In the market, hope moves money. The numbers don't lie. Watch them closely, because they're often the first to reveal what's coming next. To understand the relief rally, you have to grasp the fear that came before it. The market was gripped by anxiety, and the fear of the unknown loomed large. A shutdown drains money from the economy. Federal workers go unpaid, spending drops, and GDP takes a hit. The ripple effects are felt far and wide, affecting not just government employees, but also the businesses that rely on their spending. Prolonged shutdowns can even trigger a recession. The longer the shutdown lasts, the deeper the economic wounds become, making recovery more challenging. The uncertainty spreads. Consumers cut back, businesses freeze hiring, and confidence collapses. This creates a vicious cycle where fear feeds into economic stagnation. Consumer sentiment recently hit a 3-year low. People were scared. When consumers lose confidence, they spend less, which further slows down the economy. The market hates this kind of paralysis. Investors thrive on certainty and predictability, and a shutdown disrupts both. Investors fled stocks for safer assets, driving the market down. Gold and treasury bonds became the go-to options as they sought refuge from the storm. Another problem: no government data. The absence of crucial economic indicators left everyone guessing. Key reports on jobs and inflation were delayed, leaving everyone in the dark. Without this data, making informed decisions became nearly impossible. This data fog made it nearly impossible for the Fed and investors to make informed decisions. The lack of clarity created a breeding ground for speculation and fear. The market craves information, and a shutdown starves it. Without data, the market is left to navigate blindly. That's why the fear was so intense, and why the relief was so dramatic. When the shutdown ended, the floodgates of relief opened, and the market surged. Uncertainty is the market's worst enemy. Clarity is priceless. The return of stability brought a much-needed sense of direction. Tech stocks took the hardest hit during the shutdown. The Nasdaq Composite lost 3% in a week, its worst since April. Investors questioned if sky-high tech valuations, especially in AI, were justified. The shutdown fueled doubt, and nervous investors cashed out. But tech stocks are all about the future. They need stability and confidence. When shutdown fears peaked, risk appetite vanished. The moment a deal seemed possible, tech led the rebound. The Nasdaq 100's 1.5% surge showed investors still believed in tech's long-term story. The sell-off was panic. The rally was faith restored. In tech, fear fades fast when hope returns. The market never stays still for long. Just as AI bubble fears peaked, a key report from TSMC changed the mood. TSMC, the world's top chipmaker, posted strong October revenue, driven by booming AI hardware demand. This wasn't hype, it was real money, real orders. TSMC's results proved the AI boom was more than just talk. Investors saw that big companies were still pouring billions into AI, even during uncertainty. This news separated short-term political drama from long-term tech growth. The combination of TSMC's report and shutdown deal hopes sent tech stocks soaring. Sometimes one company's numbers can calm an entire market. The AI story is real, and it's powering the next rally. Don't lose sight of the big picture. The shutdown didn't just freeze government services, it blinded the Federal Reserve. The Fed relies on government data to set interest rates and guide the economy. With key reports delayed, the Fed was flying blind. Before the shutdown, markets expected a possible rate cut in December. But without data, the Fed couldn't act confidently, raising the risk of a policy mistake. Investors were left guessing, and uncertainty soared. Ending the shutdown would restore the data flow, letting the Fed make informed decisions. That's why Wall Street was desperate for a resolution. The Fed needs data, the market needs clarity. When both return, stability follows. Watch the Fed's next move closely. The shutdown drama didn't just move stocks, it shook up gold and oil too. Gold prices jumped nearly 2%, driven by a weaker dollar and hopes for a Fed rate cut. Investors often buy gold in uncertain times, but this time, the rally signaled confidence that the economy was stabilizing. Oil prices also rose, reflecting bets that demand would rebound as the government reopened. A shutdown slows the economy and energy use. An end means more travel, shipping, and manufacturing. The synchronized moves in stocks, oil, and gold all pointed to renewed optimism. Traders were betting on growth, not fear. The rally in gold and oil confirmed the market's belief that clarity was returning. When Washington whispers, every market listens. Watch commodities. They tell the story behind the headlines. The market's mood is contagious. Confidence spreads fast. In the end, it's all about confidence. The shutdown crisis eroded trust in government and the economy. The rally on November 10th was confidence restored. A deal means back pay for workers, resumed business, and a return of vital economic data. But the bill isn't law yet. Any snag could reverse the optimism. Watch for the final vote and the first wave of delayed economic reports. This episode proves how tightly politics and your money are linked. The market's rally shows that stability is worth real dollars. As the dust settles, focus shifts back to fundamentals: earnings, inflation, and Fed policy. The scars of this shutdown will linger as a reminder of how fragile confidence can be. Stay informed, stay diversified, and always expect the unexpected. Your financial future depends on it.